Rick, take it away.
Yes, our September read on the wholesale side of prices in the form of the producer price index. September read on the headline month over month expected up 0.3% is up 0.5%. Up 0.5%. That follows a yet unrevised up 0.7, which was the highest going all the way back in terms of month over month change to June of 22. Strip out the all important food and energy component. We're up 0.3, a little hotter than the 0.2 we were expecting, up 0.3 versus last month, up 0.2. But the previous month, July, was up 0.4%. Strip out food, trade, and energy, up 0.2 as expected, following up 0.3. Now, the year-over-year numbers on final demand, which is basically the year-over-year headline, up 2.2%. Last look was up 1.6.
Okay. Now, what I want us to get out of this is that if you take a look at core, which depends on what core you want to look at, we're right in line with where we're supposed to be. The expectations were 0.2 and it came in at 0.3, and that is X food, X energy. If you X trade, which is what most people look at, or at least I look at, it was supposed to be 0.2 and it came in at 0.2. The fact is it came in a little bit hotter on the 2/2 versus the 1 point from last one. Doesn't bother me. And the reason it doesn't bother me is what he was just saying, is that June was so low. You can't take any one of these months by themselves. You have to take them in an aggregate and average them out over at least a 3. I usually try to do a 6-month time frame, but at least a 3-month time frame. It's going to give you a better read on what actually happened, because you have some things that get pulled forward or pushed back and revised and all that baloney. So the question is, how did the market respond to this? Again, as I keep telling you, it doesn't really matter what the numbers are. The question is, how does the market take it? Well, at the beginning of the day, the market went up and kind of ended up the day exactly where it started the day, even though in the middle of the day it started petering out. So the question is, why did the market react the way that it did in the beginning? Well, part of it might be algorithms. Part of it might be that nobody really cared and wasn't really looking at all that. We're kind of looking forward to tomorrow, because tomorrow is really the one that most people look at. Whether it's accurate or whether it should be looked at or not, it's another story. But tomorrow with the CPI and the core CPI, which everybody seems to kind of look at, even though the one that's really looked at by the Fed is the PCE, but tomorrow's kind of the big headline one. But barring any of that, what you had today is no one really made a big deal out of it. There weren't a lot of headlines. Yes, it was higher, but not massively hotter. I mean, again, it was hotter than expected, but still, everything still seems to be coming down. If you're at 0.3 and you're really trying to be at 0.3 or under, even though last month was 0.2, again, I'm not that concerned about it. So why did it sell off this in between? Well, I think what I started seeing was a lot more people talking about the fact that it was hotter. And well, what if tomorrow comes in hoot hot? What if tomorrow the core is up? And again, we can have all these what ifs, and we have some people that were trying to trade on that and make a bigger issue out of it. And I don't see that being a problem. Well, then we start hearing the former Fed president who comes on.
CPI coming in above expectations. Join us now with a look at how the Fed will likely view this number. Former Dallas Fed President Robert Kaplan is the co-chair of the Draper Richards Kaplan Foundation. Good morning to you. I'm putting you back in the room with Jay Powell on this morning. You just saw the numbers. You know the context and the background of where we are. What would you be telling him?
I would still probably do nothing in the meeting that's coming up in November. And the reason for that is we've had a very substantial tightening away from the Fed in the Treasury curve.
So again, what he's saying is exactly what I've been trying to say. With interest rates going up the way the Treasury yields going up the way they have, it's really helped the Fed in the fact that they don't have to make a lot of moves here. And even though this is a little bit hotter, it shouldn't be enough to make them make a move. Now, if you get 2 months in a row of this, then okay, maybe we can talk about it. If CPI tomorrow comes in hot and the next month CPI comes in hot, okay, maybe we can talk about it. But even the former Fed is talking about this, that this shouldn't be an issue right now. So I think the market was looking at it the same way he was looking at it here. Again, I think that kind of reversed itself for a little bit until we got the Fed minutes out there. Now, the Fed minutes came out and said the same thing I told you that I got out of the Fed minutes from when it came out, when he actually spoke, not the actual minutes. And that is that the old statement of higher for longer. It's not higher for longer. It's where we're at for longer. Because again, where we're at is where we were at in the 90s, and we all lived with it. It was all fine. It wasn't a big deal. So when you dig into what they're actually saying is, yes, maybe there's another quarter point, but most of them were saying they felt that they were restrictive enough that all they really had to do was kind of sit pat, stick with where they're at, barring something else happening. This is all they need to do. And the market liked that. Now, again, it's muted because the day ended up 0.7% on the NASDAQ until tomorrow's numbers, which can totally flip all of this. So again, don't be investing on this data. Don't focus on it that much. It is an issue on a short-term basis, but you can't put your whole plan involved in this particular, and even tomorrow. Now, if we do get what they're planning tomorrow, what they're planning tomorrow for CPI is 3.6. If it comes in at 3.6 or a little bit under, and core continues to go down, again, I think we're continuing to see what the Fed is looking for, and we're continuing to see a trend that's going in the right direction. But it continues to back up everything that the Fed is saying they're going to do, and they have done. Now, for those of you like myself, didn't know who this gentleman was until I saw The Big Short, I really love this video, and I don't know how much of this I'm going to run for you, but I love what this guy was talking about and has been talking about in this video, and just like the fact that he just really tells it the way that it is.
Fascinating housing market crash, and now Big Short investor Steve Eisman is homing in on the banks. The group kicks off earnings season this Friday. Steve joins us now. He's a senior portfolio manager at Neuberger Berman. Steve, always great to see you.
Thanks for having me.
You've said before, not too long ago, like 2 weeks ago, banks are completely uninvestable. I think you came on our show too the last time and said the same thing. Do you still see that? And what are you looking specifically for in earnings at this point? Is it what makes them uninvestable at this point?
Well, let's start with the conclusion. They're still uninvestable.
Okay.
We could go to the next topic if you like, but if we'll stick with this topic, the problems are net interest margins are still under pressure. There are about $2 trillion in excess deposits in the system that are going to continue to gradually lead. So estimates are still probably too high. You've got the regulators fighting, as I like to say, the generals fighting the last war. They're increasing the capital requirements of the banks when really what they need to do is just improve the liquidity of the mid-cap and small-cap banks. And so that'll hurt returns next year. And I mean, I have no prediction about there being a recession at all. As of now, there's no data, but let's assume there is one. You haven't.
Now, for those of you who've heard me really complain about the people that come onto these shows, they give these broad strokes and say they don't like things or they like things, but they don't give you data or explanations as to why. This guy actually gives you explanations to why, and he just explained to you why he doesn't like the banks in this position. He's also explaining to you why he doesn't think there's a recession, given today's data. Again, not that that can't change, but he's been very clear about it. And I love that fact. He actually comes in here and explains himself rather than giving these broad strokes. And he also doesn't let people get on him and put words in his mouth.
Not had a credit cycle yet. So the only reason to invest in banks is that they're cheap. But there's one thing I've learned in my career, and I've only had to learn this the hard way multiple times, is investing in something just because it's cheap is a value trap, and shorting something just because it's expensive is a death wish.
Now, I want you to take what he's saying here for heart, because I get calls from people all the time, and they're saying, well, hey, let's buy this. It's cheap. Okay. Probably cheap for a reason. Okay. And not that you can't get it, and not that you can't get it right, but most of the time, the market's going to get it right. You're not. It's the same thing with shorting, same thing with being long. So again, I love his answers. They're very succinct, they're very concise, and they're really to the point, and they're very true.
So I'll be on the calls, and then thankfully the weekend will start, so people won't be all that depressed about it.
You're also not optimistic, if I can put it that way, about the consumer. And is that
Oh, that's not fair. That's not true at all.
Oh, it's not? Okay.
You've got wrong information.
Okay.
See, I love that. Here she's putting words in his mouth, and he just shuts it down. That's not what I said. That's not a right. Boom. And then he goes on to explain.
You like the consumer where they stand.
It's not that I like the consumer. I mean, in terms of the overall health of the economy, the consumer is fine. The consumer has savings, the consumer is employed, the consumer has income. So it's not a data point in terms of there being a recession. Where I think you could be negative is just that, rates are a lot higher. It's more expensive to buy a house. It's more expensive to buy a car. It's more expensive when people finance something. It's more expensive to put a solar panel on your house. So any part of the economy that's involved with the consumer buying something that also requires it to be financed has problems. That's not an indictment of the consumer. That's just a mathematical fact.
So
See, I love that. And you guys have all heard me say this. This is exactly what I've been trying to say, and he's probably saying it better than I have, which is simply, yes, things are more expensive. This is a fact. That doesn't mean that consumers cracking. It just means that they're going to have to change the way they spend and what they're doing. They're fine. There's nothing wrong with it. They're not running out of money, and it's nothing to run for the hills. But there are going to be some changes in the way they do certain things. They're not going to be able to finance the car that they could 2 years ago. They cannot finance the house they could 2 years ago. Again, these are just facts. It's not an indictment, just like he said. Again, he says it better than I do, but I love the way he talks about it.
are you positioned to reflect that? In other words, are you short any of the?
Well, I don't short for
these-
clients
okay, you don't
anymore.
short it out.
But I wouldn't own home builders right now. I mean, they've had a great run, but the home builders have been subsidizing their customers with lower rates. But even that's going to bite. I wouldn't be involved with building products to any significant degree on the residential side. I don't think you should buy somebody who finances new cars or used cars, et cetera. Anything in that universe, I think is just going to have trouble just because of simple math. I mean, I did this calculation when mortgage rates were 7%, now they're 8%. But when they were 7%, for you to buy somebody out of a house where they have a 3% mortgage, for you to have the same monthly payment, the house price had to be down 40%. So now it's 50%.
Wow.
That's just math. Now, no one's going to sell their house down at all if they have a job. They just won't move.
And again, it's very concise. It's very succinct, but he gives specifics. He's telling you that with rates the way they are, barring some outside force, somebody with a job, somebody that doesn't need to move, isn't going to sell their house when they're only going to be able to buy something they could buy 2 years ago at 50%. The prices aren't going down 50%.
So the housing market is locked. People can't buy and they can't sell. Now, the housing market is not nearly as important a part of the economy as it was in 2008. It doesn't help the economy, but I'm surprised as everybody else that the economy is as strong as it is. You have to respect it.
So again, the other thing he's saying is that he's surprised, but he respects it. A lot of people get angry about it or fight it and say that it's not true. He's recognizing the fact that the economy is stronger than expected. Okay, which is what I've been saying. Deal with reality. Deal with what's actually happening rather than complaining about what should be happening and isn't.
Talking about the consumer, you think the consumer's in okay shape, but isn't able to do the things that they've been doing in the last couple of years, buy cars, buy
Less of
houses.
it.
Right, less
Correct.
of it. So ultimately, how do you think that stalemate resolves? Do they continue to not buy those things?
I think they continue to not buy
and
those things.
rebuild their sort of savings and then ultimately spend again, or just
Yeah, I think that's probably what happens. I mean, like I said, you would have thought, given what's gone on with rates at this point, that the economy would be in a recession. And not only are we not in a recession, we're not even close to a recession.
So here's a guy who's been through it, and he's being very clear about this. We're not close to a recession. Again, it's not that people aren't going to pull back. They are, because they can't do what they used to do, and that's okay. And maybe they'll have to save up for 2 years to buy something that took them 6 months to save up before. That's not a bad thing.
So, look, I'm not an economist. I think everybody should have a little humility at this point about predicting recessions. I watch your show. I watch other people's shows. I read other people. So there were people who were negative going into the year that became positive. There were people who became positive, were negative. They've all been wrong. So everybody should just take a step back, take a breath, and just say the data currently says there's no recession, and we'll see what happens.
Love that. And that's how I've been trying to get all of you to look at the market. Take the data as given to you, make adjustments as necessary based upon actual data rather than made up things or wishful thinking or other ideas. Again, the market was up a little bit, was down a little bit, ended up. Again, what's that mean for the long term? Absolutely nothing. So make sure your portfolio is set up for your long-term goals and objectives so you can retire when you want to retire and how you want to retire. Dickie out.